Good morning, Michelle. Thanks very much for joining us on Blue Notes once again, the morning of the bank's annual result. A strong result on many fronts, and particularly capital generation. So can you talk us through how you're balancing capital generation, extra capital from divestments, and then the potential to pay back some capital maybe to shareholders?
Yeah, I mean, the core of our strategy really is about how we optimise our capital. So we put it to its best use. And this year, we've done two things. It's about how we allocate the pie. And we wanted more of our capital allocated to Australia and New Zealand and less to institutional, and we've done that. And then it's about driving better returns in the businesses, and we've done that as well. At the same time, we've generated capital, and pleasingly we're sort of 2 years ahead of where we need to be based on APRA's new requirements, and so that gives us lots of flexibility going forward.
Provisions for bad and doubtful debts continue to come down, which is obviously good for earnings. But is there a concern that the banking world is perhaps underpricing risk? Are these lower provisions sustainable?
I mean, again, core part of our strategy is making sure we use our capital where we think we can optimise the risk-adjusted returns on that capital. So for example, selling out of Asia retail, which for us, given our scale in that market, we weren't driving the right risk-adjusted return. So it makes sense for us to do that. It's the same with the way we're reshaping the institutional business to focus on areas and customers where we feel we bring real value to them. And so if you look at it this year, we've improved risk-adjusted returns. Clearly there's been some the market environment has been good as well, but we've also made some structural changes in our business.
And the cost story too is another very strong element of this story. And Shane Elliott said that the focus on costs, on absolute costs, is going to continue. There's been a reshaping of the business, so we've seen costs come out. So how much more can be done on that absolute cost front?
Yeah, I mean, as we look at it, there are financial and business reasons for what we're doing. Financially, when we look at the environment, we think a focus on costs is absolutely right. Included by the fact that we're reshaping our business, and so we need to be serious about our cost base. But more importantly, when we look at the bank, we think that being simpler and more focused is really what's going to help us win in the long term with customers, and just by having focusing on a few areas and doing them really well. And so the absolute cost focus will absolutely continue.
And once again in this result there's evidence of pressure on net interest margins, and that's really an industry-wide phenomenon, and it's a sort of longer term trend. What's the outlook for net interest margins?
Yeah, and margins have been coming down for years now, and that's one of the reasons actually why we're focused on using our capital in the most efficient way and focused on costs. If I look at margins this year, there are probably some positives and negatives, particularly in the last half. Outside of the markets business, margins actually improved a bit in the second half, and we had some sort of positives going on compared to the first half around asset and liability pricing. But on the flip side, as we go into next year, we will have a full year of the bank tax as well.
And you referred to the reshaping. Part of that is the divestment of businesses, and we're seeing that's sort of ongoing, and there's a couple more on the horizon down the track. But does that mean that while it's obviously good for the management of the balance sheet and the way that the business is focused, does it leave you with an earnings gap going into the future?
Yeah, I mean, if I step back and say why are we selling these businesses, again, we think we're better off focusing the bank on a few areas and doing them really well. And so there are things like Asia retail, for example, where we're just not the best owner of that business because we're subscale, and if we kept that business, we'd need to keep investing in the business, and that would take money away from our core businesses. Now, selling a business, of course, it's got revenue associated with it, it's also got costs and provisions. But after that, yes, there is a short-term revenue implication of selling the business. At the same time, we no longer need capital allocated to the business, so we have a benefit there. So you've got to weigh those two things up.
Well, thanks very much again for your time with Blue Notes.